A ledger closes on a Friday evening with every column balanced, and by Monday morning the man who kept it owns nothing. That gap between the two entries is where this list lives. It is not a list about markets, and it is certainly not a list about what you should do with your own money. It is a list about people and about the strange, specific afternoons when what they had built came apart faster than anyone watching could quite explain. Some of these fortunes fell to war, some to fraud, some to nothing more than a bank quietly running out of gold in its vaults while a line of depositors grew outside the door. A king lost his kingdom's gold to an invading army. A finance minister lost his palace 3 weeks after showing it off to his own king. A physicist who could calculate the motion of planets could not, it turned out, calculate a crowd. 50 stories, 50 very different rooms, and in each one a single day that changed everything after it. What connects them is not a lesson exactly. It is closer to a pattern old enough to have outlived every currency it has ever ruined. Settle in. Some of what follows you may already half know. Most of it, told properly, you will not. Isaac Newton owned shares in the South Sea Company, and in the spring of 1720 he sold them at a tidy profit, satisfied with a job well done. Then he watched the price keep climbing without him, and did what a great many careful people have done before and since. He bought back in, near the very top of a bubble that had months, not years, left to run. The South Sea Company had been granted a monopoly on British trade with Spanish America, a trade that in practice barely existed. What did exist was a scheme to swap government debt for company shares, and a public convinced by rising prices that the company's fortunes must be as bright as its stock chart suggested. Shares that had traded around £120 in January reached over £1,000 by August. Newton, one of the most celebrated minds in Europe, was far from alone in watching the climb and concluding that this time the crowd knew something he did not. When the shares collapsed that autumn, falling back toward where they had started within a matter of weeks, Newton lost roughly £20,000, a sum that by some estimates would take an ordinary skilled worker a lifetime to earn. He never fully recovered the loss, and reportedly banned the mention of the South Sea Company in his presence for the rest of his life. The line often attributed to him afterward, that he could calculate the motions of the heavenly bodies, but not the madness of people, may be more legend than verified quote, but it survives because it captures something true. Mathematics had never promised to protect anyone from a crowd's mood. The universe kept its laws, the market did not. For a few months in the winter of 1979 and 1980, two brothers from Texas controlled enough of the world's silver that they could move its price almost by breathing. By the afternoon of March 27, 1980, that control was gone, and so was most of what they owned. Nelson Bunker Hunt and William Herbert Hunt had inherited an oil fortune and turned a portion of it towards silver, quietly buying futures contracts and physical bars until they and their partners held a position estimated at close to 200 million ounces. The price, which had sat under $6 an ounce a few years earlier, rose past $50 in January 1980. Silverware was melted down across the country by people hoping to cash in on the spike. Regulators, alarmed at how much of the market two brothers now controlled, changed exchange rules to make it harder to buy on credit and easier to sell. The price began to slide, and the Hunts, who had borrowed heavily against silver they already owned to buy more silver, faced margin calls they could not meet without selling into a falling market. On March 27, a day traders still call Silver Thursday, the price fell by more than a third in hours, dropping from around $21 to around $10. Banks scrambled to arrange an emergency loan large enough to keep the brothers from defaulting outright and threatening the wider financial system with them. The Hunts survived the day only barely, and spent the following years fighting lawsuits and eventually filing for bankruptcy protection. The silver went back to being a metal traded in ounces, not empires. In October 1929, as fortunes across America turned to ash within days, one man on Wall Street quietly became one of the richest people in the country. Jesse Livermore had bet the crash was coming, and when it arrived he was on the winning side of nearly everyone else's ruin. Livermore had spent decades building a reputation as the market's most feared short seller, a trader who profits when prices fall rather than rise. He had already made and lost several fortunes by 1929, having started as a teenager reading tape in Boston bucket shops before graduating to the real exchanges in New York. Sensing the excesses of the late 1920s boom, He positioned himself against the market rather than with it, and when Black Tuesday and the days around it wiped out other investors, Livermore's short positions turned into an estimated $100 million in profit, an almost unthinkable sum for the era. He did not keep it. Over the following decade, a combination of poor personal decisions, a costly divorce and trades that failed to repeat his earlier instincts eroded the fortune steadily until it was gone. By the late 1930s, Livermore, once celebrated in the financial press as the Great Bear of Wall Street, was effectively broke. In November 1940, he died by his own hand in a New York hotel, leaving behind a note that spoke of a life that had, in his own estimation, become a failure. He had beaten the market more completely than almost anyone in its history, and it still outlasted him. Consider a nation deciding in effect to bet its treasury on a single roll of the dice. At the close of the 17th century, Scotland did exactly that, and the dice came up badly. The Company of Scotland was founded in 1695 with grand ambitions to establish Scotland as a trading power independent of its larger neighbour. Its chosen venture was a colony at Darien on the Isthmus of Panama, meant to become a hub connecting Atlantic and Pacific trade long before any canal existed to do the job properly. Investors across Scotland, from nobles to merchants to ordinary tradesmen, poured in an estimated £400,000, a sum some historians place at close to a fifth of the entire nation's circulating wealth. The colony that resulted was a catastrophe almost from the first ship's arrival in 1698. The land was disease-ridden, the promised trade never materialised, and England, wary of provoking Spain's claims in the region, refused to send help or supplies. Roughly 2,000 colonists died of illness and starvation within the venture's first years. A second wave of settlers fared little better, and the colony was abandoned entirely by 1700, its investment a total loss. The financial ruin that followed weakened Scotland's negotiating position so severely that many historians consider Darien's failure a direct contributor to the Act of Union with England in 1707, which folded Scotland's Parliament into Westminster's. A colony meant to make Scotland independent ended up helping erase its independence instead. The Treasury emptied, and the flag came down before it had properly gone up. There is a reason the phrase rich as Croesus has outlived the actual kingdom of Croesus by roughly 26 centuries. He was, by the standards of his age, almost impossibly wealthy, and the story of how completely he lost it has outlived the gold itself. Croesus ruled Lydia, a kingdom in what is now western Turkey, in the 6th century BC. Lydia sat astride rich gold deposits and controlled trade routes between Greece and the interior of Asia, and Croesus is often credited, alongside his predecessors, with minting some of the earliest coins in history, standardized pieces of precious metal that made trade dramatically easier across his territory. His court became a byword among Greek writers, for splendor almost beyond description. Ambition, or perhaps overconfidence, led Croesus to challenge the rising Persian Empire under Cyrus the Great. According to the historian Herodotus, Croesus had consulted the oracle at Delphi before going to war, and received an answer that seemed to promise victory, though as with much oracular advice the promise depended entirely on which side one favoured in the reading. The campaign went badly. Cyrus defeated Croesus' forces, captured the Lydian capital of Sardis in 546 BC, and with it the kingdom's famous treasury. What happened to Croesus personally afterward is disputed among ancient sources, with some accounts describing an attempted execution interrupted by fate and others a quieter fall from power. What is not disputed is that the wealthiest king of his age lost his entire kingdom to a rival within a single military campaign. The gold went into someone else's treasury, and the name went into the language instead. A furrier's son from Bourges built the largest trading fortune in 15th century France, financed a king's wars, and ended his career in a prison cell with every coin of it seized. The rise is remarkable, the fall is what people remembered. Coeur began in the fur and textile trade, before expanding into shipping, mining and finance across the Mediterranean, eventually operating trading posts from Egypt to the French coast. His success brought him to the attention of King Charles the Xth, whom he served as treasurer and financed heavily during the final campaigns to expel English forces from France, campaigns that included Joan of Arc's famous relief of Orléans. Coeur became, in effect, the richest commoner in the kingdom and one of the few men wealthy enough to personally bankroll a war. That wealth and the resentment of noblemen who owed him money proved dangerous. In 1451, Coeur was arrested on a set of charges, including an accusation of poisoning a royal mistress that most modern historians regard as almost certainly fabricated by rivals eager to see his fortune redistributed and his debts to them erased. He was imprisoned, tortured, and stripped of the entirety of his considerable estate. He was eventually released years later and even sent on a papal mission before he died. But the fortune itself never returned to him. The king who had needed his money to fight a war found it just as useful to seize once the war was won. On a single Friday in October 1307, sealed orders went out simultaneously to royal officials across France. By the day's end, nearly every Knight Templar within reach had been arrested, and the order's considerable financial holdings had passed into the hands of a king who owed it a great deal of money. The Knights Templar had begun 2 centuries earlier as a military order protecting pilgrims to the Holy Land, but over generations they had developed into something closer to Europe's first international bank. Their network of fortified houses allowed travellers and monarchs to deposit funds in one location and withdraw an equivalent sums elsewhere, an early form of the letter of credit that modern banking still relies on in spirit. King Philip IV of France had borrowed extensively from the order, and by most historians' reading, saw more benefit in eliminating his creditor than in repaying him. Philip coordinated with the Pope to bring charges of heresy and corruption against the Templars, charges historians widely regard as fabricated, or at minimum wildly exaggerated for political convenience. The arrests on October 13, 1307 were executed with striking coordination for the era, catching most of the order's leadership before word could spread and allow any organised response. Torture extracted confessions to the charges. The order was formally dissolved by the Pope in 1312, and its considerable French holdings were absorbed into royal and allied hands. A network built to move money safely across a continent could not, in the end, move quickly enough to save itself. Nicolas Fouquet threw the finest party of his life on August 17, 1661. 3 weeks later he was arrested, and would never again see the palace he had built to host it. As finance minister to the young Louis XIV, Fouquet had grown enormously wealthy, partly through legitimate financial acumen, and partly, by most accounts, through the kind of creative accounting that finance ministers of the era were rarely punished for. He used a portion of that wealth to build Vaux la Vie Coeur, a chateau of such staggering ambition that it employed the era's finest architect, painter and landscape designer, the same trio who would later be assigned to build Versailles. When Fouquet hosted the king himself at the chateau grand opening, complete with fireworks, a specially commissioned play by Molière, and a feast served on solid gold plate, he intended to impress his monarch. He succeeded too well. Louis, by most historical accounts, left the evening less admiring than humiliated, unable to shake the sense that his own finance minister was living more grandly than the crown itself. Whether out of genuine suspicion of embezzlement or simple wounded pride, Louis had Fouquet arrested weeks later on charges of financial malfeasance. Fouquet was imprisoned for the rest of his life, his estate confiscated, and his palace's architectural team promptly reassigned to build something even grander for the king who had just ruined him. The party was the last night the chateau ever belonged to the man who built it. A merchant family from the German city of Augsburg once financed the elections of Holy Roman emperors and funded the wars of Spanish kings. Their fortune rested, in the end, on the promise that a king would eventually pay them back. The Fugger family had built their wealth over generations through mining, textiles, and increasingly through lending to Europe's royal houses, becoming so essential to imperial finance that Emperor Charles V's election in 1519 was reportedly secured in large part through bribes the Fuggers arranged and financed. Charles' son, Philip the Escand of Spain, inherited both his father's crown and his father's habit of borrowing heavily from Augsburg's bankers to fund an empire stretched thin across 2 hemispheres and near constant warfare. Spain's finances, dependent on silver shipments from its American colonies that arrived unpredictably and were frequently pledged several times over to different lenders, proved unable to keep pace with royal spending. In 1557, Philip formally suspended payments on much of the crown's debt, a default that devastated the network of German and Italian bankers who had extended it, the Fuggers prominent among them. The family survived, having diversified enough to absorb the blow, but the loss marked the beginning of a long decline from the towering influence the Fuggers had once held over European finance. A crown's word had once been worth more than gold. For one generation of bankers, it turned out to be worth considerably less. A bank that once financed popes and funded the flowering of Renaissance art closed its final branch in 1494, brought down not by a single catastrophe, but by a slow accumulation of bad decisions that finally came due all at once. The Medici Bank had been built in the early 15th century on a foundation of careful conservative lending, deliberately avoiding the kind of risky sovereign loans that had ruined earlier Florentine banking houses. Its branches stretched across Italy and into London, Bruges and beyond, and its profits helped fund Cosimo and later Lorenzo Dei, Medici's patronage of artists and architects whose work still defines how the Renaissance is remembered. For decades, the bank's discipline was the very thing that separated it from its failed predecessors. That discipline eroded under later management. Branch managers extended loans to unreliable rulers, including a costly and ultimately unrecoverable loan to King Edward IV of England, and the family's growing political entanglements in Florence distracted from the careful oversight the bank had once been known for. When the Medici family was expelled from Florence in 1494 amid a broader political and military crisis involving an invading French army, the bank's remaining assets were seized or scattered, and what remained of the institution was formally wound down. A fortune built one careful loan at a time proved far easier to lose through simple neglect. Wall Street's first true financial panic had a single name attached to it, and that name belonged to a man who had, until recently, held one of the new American government's most trusted financial positions. William Duer had served as an assistant to Treasury Secretary Alexander Hamilton, and used the connections and knowledge gained there to speculate heavily in government securities and bank stocks in the early 1790s. He borrowed extensively, often from friends, acquaintances, and eventually from people who barely knew him, promising extraordinary returns, as he attempted to corner the market for federal debt and shares in the newly formed Bank of the United States. For a brief period, his apparent success drew still more investors eager to ride along. The scheme depended on continually finding new lenders to repay old ones, a structure that could not survive once confidence wavered. In March 1792, Duer's inability to meet his obligations became public, and the resulting panic spread through New York's small but interconnected financial community, ruining a number of ordinary investors who had trusted his reputation. Duer himself was arrested for debt and spent most of the rest of his life imprisoned, his once glittering connections to the highest levels of the young government doing nothing to soften his fall. The Republic's stock market was barely 3 years old, and it had already learned its first hard lesson about borrowed confidence. The banker who had helped finance an entire war watched his own institution fail within a single business day, brought down not by the war he had once helped win, but by a railroad he could not stop believing in. Cooke had built his reputation during the Civil War by selling government bonds directly to ordinary Americans on a scale no one had attempted before, raising enormous sums for the Union war effort and earning himself the label of the financier of the war. After the war, Cooke turned his attention and his firm's substantial resources toward financing the Northern Pacific Railway, a transcontinental line meant to open the Pacific Northwest to settlement and trade. The railroad proved far costlier and slower to complete than projected, and Cooke's firm had committed itself so deeply that it could not raise new capital fast enough to keep construction funded. On September 18, 1873, unable to meet its obligations, Cooke and Company simply closed its doors, an announcement that shocked a financial world that had regarded the firm as practically unshakable. The failure set off a broader panic across American markets, closing the New York Stock Exchange for 10 days and triggering a depression that lasted years. A man who had once sold the public on a nation's survival could not, in the end, sell them on a railroad's completion. Two of the era's boldest financial operators tried for a few weeks in 1869 to control the price of gold itself. It went about as well as most attempts to control a market larger than any one person's pockets. Gould and James E. Fisk quietly accumulated large positions in gold, aiming to drive the price upward and profit enormously when it did. Their scheme depended on the federal government not selling gold from its own reserves to counteract the price rise, and the pair reportedly cultivated a relationship with President Ulysses S. Grant's brother-in-law to gain insight into, and possibly influence over, government policy on the matter. For a time it appeared to be working, as the price climbed steadily through September 1869. Grant, alerted to the scheme, ordered the Treasury to sell $4 million in gold on September 24, a day that became known as Black Friday. The government sale broke the corner instantly, and the price of gold collapsed within hours, ruining a number of investors, brokers, and firms who had bought in on the expectation of further gains. Gould and Fisk themselves managed to escape the worst of the damage through timing and connections that other investors did not have, a detail that did little to endear either man to the public afterward. The market had been briefly cornered by two men and freed again by one government sale. For over a century, the House of Beering had been considered among the most conservative and trustworthy names in London banking. In 1890, that reputation nearly was not enough to keep the bank's doors open. Baring Brothers had extended enormous credit to Argentina, financing government bonds and infrastructure projects during a period when British investors regarded Argentine debt as a promising if distant opportunity. Argentina's economy, however, proved far less stable than the confident prospectuses had suggested, and by 1890 the country's finances had deteriorated to the point that it could not service its obligations. Baring, having committed itself so heavily to Argentine bonds that it held far more risk than its capital could absorb, suddenly faced the prospect of insolvency. Word of Baring's exposure spread through London's financial circles, with the particular speed reserved for news that threatens everyone's confidence at once. Recognizing that Baring's outright collapse could destabilize the entire British banking system, the Bank of England organized an emergency guarantee fund, with contributions from rival banks who understood that letting a competitor fail might not spare them the consequences. The rescue held, and Baring survived, though diminished and forever marked by how close it had come. A century of caution had built the reputation. One overconfident decade in South America nearly spent it. Charles Ponzi promised investors they could double their money in 90 days by exploiting tiny discrepancies in international postal reply coupons. Thousands of people believed him. A single week of scrutiny was enough to prove them wrong. Ponzi's business, launched in Boston in 1919, claimed to profit from buying postal coupons cheaply in countries with weak currencies and redeeming them for stamps worth more in countries with stronger ones. The underlying arbitrage was real in principle, but far too small in scale and far too bureaucratically slow to generate anything close to the returns Ponzi promised. What actually funded the extraordinary payouts to early investors was the money pouring in from new ones, a structure that would eventually take on his own name as its lasting label. For a period in the summer of 1920, Ponzi's operation appeared to be an extraordinary success, drawing lines of investors outside his Boston office, and making him, briefly, a wealthy and celebrated figure. A Boston Post investigation that July began questioning the mathematics behind his claims, and within weeks, once regulators and journalists forced open his books, the entire structure was exposed as unable to cover even a fraction of what it owed. Ponzi was arrested, and thousands of investors, who had trusted a confident smile and a simple pitch, lost the bulk of what they had put in. The coupons themselves had always been real. It was the arithmetic around them that never was. One man once controlled a large share of the world's supply of an object so ordinary that almost nobody thought to ask how he had gained such control. When the truth came out, it came out all at once, and it ended with his death. Var Kreuger built the Swedish match company into a global monopoly over match production during the 1920s, expanding aggressively through loans desperate for capital after the First World War, loans he arranged in exchange for match monopolies in their territories. His financial empire grew to encompass banking, mining and telecommunications interests as well, all financed through an elaborate structure of holding companies that made his actual balance sheet almost impossible for outsiders, or apparently even his own accountants, to verify. That opacity, it turned out, concealed a mountain of forged Italian government bonds and financial statements that had been fabricated for years to maintain investor confidence and keep new capital flowing in. As the Depression tightened credit worldwide in the early 1930s, Kreuger's need for fresh money outpaced what even his considerable talents for persuasion could secure. In March 1932, facing imminent exposure and collapse, Kreuger died by suicide in his Paris apartment. Investigators who examined his companies afterward found a fraud of a scale that shocked even seasoned financial regulators, and the collapse wiped out investors across Europe and America. The matches kept lighting. The empire built to sell them did not survive its own paperwork. London's investment class handed real money to a country that did not exist, on the word of a man who had invented not only the country but a noble title of his own to sell it with. Greg, or Mugre, was a Scottish soldier who, after a colourful and not entirely distinguished military career in South America, returned to Britain in the early 1820s claiming to be the cazique, a princely title he had awarded himself, of a Central American territory he called Poy-ASS. He published a detailed guidebook describing Poy-ASS as a fertile paradise, complete with a functioning capital city, a parliament and even its own currency, and sold both land certificates and government bonds to British investors eager to profit from a supposedly booming new nation. None of it was true. When roughly 250 settlers sailed to claim their promised land in 1823, and they found nothing but uncleared jungle and no trace of the capital, government or infrastructure the guidebook had promised, many died of disease and starvation before rescue ships could return the survivors home. MacGregor, remarkably, was never seriously punished under British law for the fraud, and continued attempting similar schemes for years afterward, though never again on quite the same scale. The bonds had promised a nation. What the settlers found was a coastline with no name attached to anything real. A single Austrian bank's failure in the spring of 1931 rippled outward across a continent already weakened by years of economic strain, proving how tightly connected Europe's finances had become despite its many borders. Credit Anstalt had long stood as Austria's largest and most important bank, deeply woven into the country's industrial and commercial life through decades of lending to major firms. By 1931, years of loans to struggling businesses in the aftermath of the First World War and the onset of the Great Depression had left the bank holding assets, worth far less than the deposits and obligations against them. When the scale of the shortfall became public in May of that year, depositors and foreign creditors alike moved to withdraw funds as quickly as possible, a rush no single institution's reserves could withstand. The Austrian government stepped in with emergency guarantees, but the damage had already spread beyond Austria's borders. Foreign banks with exposure to Credit Anstalt, particularly in Germany, faced their own liquidity crises within weeks, contributing to a wave of banking failures across Central Europe that summer. Historians studying the period often point to Credit Anstalt's collapse as one of the moments that turned a regional economic downturn into something closer to a continental crisis. One bank's overextended loans became, within a season, half a continent's problem. Other bankers called it the Bankers' Bank, a firm so trusted that rival institutions kept their own emergency reserves parked with it. On a Friday in May 1866, that trust proved to have been extended well past what the firm's own books could support. Overend, Gurney and Company had built its reputation over decades in the discount trade, essentially lending short-term against bills of exchange in a business considered conservative almost by definition. Under newer management in the 1860s, the firm drifted into much riskier long-term loans to shipping and railway ventures, many of them poorly secured and some to borrowers with little realistic prospect of repayment. The firm converted itself into a limited liability company in 1865, a move that, whatever its intent, gave its existing partners a convenient way to spread the risk of the bad loans already on the books onto new shareholders. When the scale of those bad loans became apparent, the firm suspended payments on May 11, 1866, a collapse severe enough to be remembered ever after as Black Friday. Panic spread through London's financial district within hours, with crowds gathering outside banks fearing further failures, and the Bank of England was forced to lend freely to steady a shaken market. Several of the firm's directors were later tried, though acquitted, on charges related to the misleading accounts that had concealed the firm's true condition for years. The Bankers' Bank had, in the end, needed a banker of last resort to save everyone but itself. A bank's directors can hide a great deal behind confident annual reports for a while. The City of Glasgow Bank hid its troubles for years before the truth arrived all at once in October 1878 and took its shareholders' entire personal wealth down with it. The bank had grown rapidly through the 1860s and 1870s, extending large loans to a handful of favoured borrowers, including struggling shipping and trading firms, in which some of the bank's own directors held personal interests. As those loans soured, the bank's management concealed the losses through falsified accounts, reporting healthy profits and paying dividends for years, even as its actual reserves dwindled toward nothing. When auditors finally uncovered the discrepancy in the autumn of 1878, the bank was forced to suspend operations within days. The consequences for shareholders were unusually severe because, unlike most modern banks, the City of Glasgow Bank operated under unlimited liability, meaning its shareholders were personally responsible for the bank's debts beyond the value of their shares. Many ordinary investors, including widows and small tradespeople who had bought shares as a supposedly safe investment, were bankrupted entirely, losing homes and savings to cover debts far larger than anything they had ever invested. Several of the bank's directors were subsequently convicted of fraud. A bank's books can say almost anything, right up until the morning someone finally checks them. A fund staffed by 2 Nobel laureates in economics and some of the most decorated traders on Wall Street lost roughly $4.5 billion in a matter of weeks in 1998. Brilliance, it turned out, was not the same thing as immunity. Long-term capital management had built its strategy on sophisticated mathematical models designed to profit from tiny, predictable price discrepancies between related securities, a strategy that had generated remarkably steady returns for its first several years and drawn some of the era's most respected financial minds to its ranks. The fund used enormous amounts of borrowed money to magnify what were, individually, small and seemingly low-risk trades, a structure that performed beautifully as long as markets behaved the way the models expected them to. In the summer of 1998, Russia defaulted on its government debt, triggering a wave of market behavior the fund's models had not accounted for, as investors worldwide fled towards safety in ways that broke the historical price relationships the fund had bet on. The fund's highly leveraged positions began losing value rapidly, and because its exposure was so large relative to the markets it traded in, its potential collapse threatened to destabilize the broader financial system. The Federal Reserve organized a consortium of major banks to inject capital and unwind the fund's positions in an orderly way, averting a wider crisis. The models had been elegant. The Russian default had not read the same textbook they had. A media magnate who had spent decades commanding headlines died at sea in November 1991, and the headlines that followed his death were far more damaging than any he had generated while alive. Robert Maxwell had built an empire spanning newspapers, publishing and television across Britain and beyond, cultivating a public image of boundless energy and confidence even as privately his companies carried debts that far exceeded what their actual profits could support. He was found dead, having apparently fallen from his yacht off the Canary Islands, under circumstances that remain disputed among biographers and investigators to this day, whether accident, misadventure, or something else entirely. What became clear within weeks of his death was that Maxwell had, for years, been secretly transferring hundreds of millions of pounds out of his company's employee pension funds to prop up his failing businesses and personal debts. The discovery devastated thousands of former employees who found their retirement savings gone, and it triggered the collapse of much of the Maxwell business empire as banks called in loans and investors fled. The fortune had, in effect, already vanished well before he died. His death simply removed the one person capable of continuing to conceal it. A reputation built on confidence lasted exactly as long as the man confident enough to maintain it. A commodities trader convinced some of the largest lenders in America that enormous storage tanks in New Jersey held vast quantities of soybean oil. Most of those tanks, when finally inspected, held mostly seawater. And O'Neill, Tino Day and Jellies ran a vegetable oil trading business that used warehouse receipts, documents certifying that a certain quantity of oil sat in storage, as collateral to borrow money from banks and brokerages, including American Express's warehousing subsidiary. He discovered that by manipulating the inspection process and reusing the same limited quantity of actual oil across multiple falsified receipts, he could borrow far more against inventory than actually existed, a scheme that grew larger and more precarious the longer it went undetected. The fraud unraveled in late 1963 when a routine business dispute prompted closer scrutiny of his company's finances, and inspectors sent to verify the oil found tanks that were, in many cases, filled mostly with water topped with a thin layer of oil to fool a cursory check. The scale of the shortfall, once totaled, ran into the hundreds of millions of dollars, dragging American Express into a financial crisis significant enough to rattle its stock, and drawing a young investor named Warren Buffett to take a notable position in the company, betting correctly that its underlying business would survive the scandal. The paperwork had described an ocean of oil. The tanks, once opened, mostly described an ocean of nothing. For a few boom years in the mid-1830s, it seemed almost impossible to lose money speculating in American cotton and land. The Panic of 1837 proved otherwise, and it proved it quickly. Rising cotton prices and abundant credit, much of it extended by state-chartered banks that had multiplied rapidly after federal banking restrictions loosened, fueled a speculative frenzy in land and cotton futures across the American South and West. Planters borrowed heavily to expand cultivation. Banks lent freely against land whose value assumed the boom would continue indefinitely, and cotton prices climbed to levels that had little relationship to actual demand in the mills of Britain and the northeastern United States that eventually bought the crop. The bubble broke in 1837 amid a combination of tightening credit from the Bank of England, a collapse in cotton prices as European demand failed to keep pace with American supply, and a domestic banking system that proved unable to withstand the resulting wave of loan defaults. Hundreds of banks failed within the following years, businesses collapsed across the country, and a depression that some historians consider comparable in severity to the later crisis of the 1930s settled over the American economy for the better part of a decade. Cotton kept growing in the fields. The fortunes built on borrowing against its future price did not survive the season. A financial instrument once dismissed as too risky for serious investors became for roughly a decade the fuel behind some of the largest corporate takeovers in American history. Then the firm that had built that market filed for bankruptcy in a single February. Drexel Burnham Lambert, an otherwise unremarkable investment bank, transformed itself in the 1980s into a dominant force in corporate finance largely through the work of one banker, Michael Milken, who pioneered the widespread use of high-yield bonds, informally known as junk bonds, to finance corporate acquisitions that traditional lenders considered too risky to touch. The market Milken built generated extraordinary fees for the firm and extraordinary personal wealth for himself, at one point reportedly earning over $500 million in a single year. Regulators grew increasingly suspicious of the trading practices underlying Milken's success, and in 1988 the Securities and Exchange Commission filed civil charges alleging insider trading and market manipulation. Milken eventually pleaded guilty to securities violations and served time in prison, and the legal and financial pressure surrounding the case, combined with a broader downturn in the junk bond market, left Drexel unable to meet its obligations. The firm filed for bankruptcy in February 1990, at the time the largest failure of a Wall Street firm in decades. The instrument Milken had made respectable outlived the firm that had built the market for it. Railroads had been laid across America faster than the traffic to fill them for years before anyone was forced to admit it. The Panic of 1893 forced the admission all at once. Following the Civil War, American railroad construction had proceeded at a breakneck pace, financed heavily through bonds and loans that assumed each new line would eventually generate enough freight and passenger revenue to justify its cost. By the early 1890s, a significant share of the nation's rail mileage had been built well ahead of the population and industry needed to sustain it, and many railroad companies carried debt loads their actual earnings could not service even in good years. A combination of falling gold reserves, uncertainty over the nation's currency policy, and a general loss of investor confidence triggered a wave of bank failures and business collapses beginning in early 1893. Railroads, already overextended, proved among the hardest hit, and within the year roughly a quarter of the nation's total rail mileage passed into receivership, including major lines like the Northern Pacific and the Union Pacific. Fortunes that barons of the industry had built over decades of expansion evaporated within months, as bondholders and shareholders discovered how little the underlying businesses could actually support. The tracks stayed in the ground. The men who had financed laying them mostly did not stay solvent. A telecommunications company that had grown into one of the largest in America through a decade of aggressive acquisitions needed its financial numbers to keep climbing long after its actual business had leveled off. the gap between what the numbers said and what the business could actually produce eventually became too large to disguise. WorldCom had expanded rapidly through the 1990s by acquiring smaller telecommunications firms, a strategy that impressed investors as long as the combined company's revenue and profit continued growing at the pace the market had come to expect. When the underlying telecommunications industry slowed sharply around the turn of the millennium, WorldCom's finance department, under pressure to keep reported results looking healthy, began improperly classifying roughly $4 billion of ordinary operating expenses as long-term capital investments, a maneuver that made the company appear far more profitable than it actually was. An internal auditor uncovered the discrepancy in 2002, and when the company disclosed the accounting fraud publicly that June, its stock price, which had already been declining, collapsed entirely within days. WorldCom filed for what was then the largest bankruptcy in American corporate history, and its chief executive was later convicted of fraud and sentenced to prison. Thousands of employees who had held company stock in their retirement accounts lost the bulk of their savings almost overnight. The revenue the company had reported for years turned out to have been, in the most literal sense, an accounting trick rather than a business. A government printed millions of dollars in currency backed by a promise that depended entirely on winning a war. When the war ended in defeat, the promise ended with it, and so did the money's value, within a matter of weeks. The Confederate States of America issued its own paper currency throughout the Civil War to fund its military and government expenses, printing increasing quantities as the war dragged on, and its ability to raise money through taxation or borrowing grew steadily more limited. Confederate notes had never been backed by gold or silver in reserve, the way many pre-war currencies claimed to be, their value resting, instead, on public confidence that the Confederacy would eventually make good on them once independence was secured. That confidence, understandably, evaporated the moment Confederate independence itself did. As Union forces occupied more southern territory through 1864 and 1865, Confederate currency had already begun losing value rapidly, a decline that accelerated into outright collapse once General Robert E. Lee surrendered at Appomattox in April 1865. Within weeks, the currency that had circulated as legal tender across an entire nation became, for practical purposes, worthless paper, useful mainly as a historical curiosity or wallpaper for households that had accumulated large quantities of it. A currency's value, it turned out, had been backed by a cause. Once the cause was lost, so was every note printed in its name. There is a particular kind of ruin that arrives not through a single crash, but through a currency simply losing its meaning, day by day, until the losing accelerates into something closer to free fall. Germany's mark endured exactly that in 923. Following the First World War, Germany faced enormous reparations payments and a government that increasingly resorted to printing money to cover its obligations, rather than raising it through taxation, a choice that steadily eroded the mark's value through 1921 and 1922. By 1923, the printing had accelerated to the point that inflation was no longer measured in months or weeks but in days, and eventually in hours, as the value of the currency in circulation collapsed faster than new banknotes. However large the denomination printed on them, could keep pace. Stories from the period, widely documented at the time and since, describe workers being paid twice daily so they could spend their wages before the money lost further value on the way home, and families using wheelbarrows to carry enough banknotes to buy a loaf of bread. Denominations eventually printed reached numbers in the trillions of marks. The crisis was brought under control only through a currency reform in late 1923 that introduced an entirely new unit of money, effectively erasing the old currency's value in exchange for restoring some sense of stability. Money had always been a kind of shared agreement. For one German autumn, almost nobody could agree on what it was worth anymore. A central bank kept adding zeros to its banknotes for years, hoping each new denomination would keep pace with prices that refused to stay still. Eventually, the zeros stopped meaning anything at all, and the country gave up on its own money entirely. Zimbabwe's economy suffered severe strain through the 2000s, driven by a combination of controversial land redistribution policies that disrupted agricultural output, government spending that far outpaced revenue, and a central bank that responded to the resulting deficits primarily by printing more currency. The predictable consequence was inflation that accelerated from merely serious to genuinely historic, with prices in some periods reportedly doubling within a single day. By 2008, the Zimbabwean central bank had issued banknotes denominated in the billions and eventually trillions of dollars, printed on notes whose face value made everyday transactions almost surreally absurd, a $100 trillion note that could barely cover a bus fare by the time it reached someone's hands. In early 2009, the government formally abandoned the Zimbabwean dollar altogether, allowing foreign currencies, primarily the United States dollar and South African rand, to circulate as the country's practical medium of exchange instead. A currency had once represented a promise a government could keep. By the end, the promise had been printed so many times it no longer meant anything to keep at all. A market that had climbed for years on an ever-expanding tide of borrowed money discovered, on one particular Tuesday, that the tide had nowhere further to rise. Throughout the 1920s, American stock prices had climbed steadily, encouraged by widespread use of margin buying, a practice that let investors purchase shares using mostly borrowed money and only a small fraction of their own. The strategy multiplied gains during the boom and drew in an increasingly broad swath of the public, from professional traders to shopkeepers and factory workers, all convinced that prices would simply keep rising. Warning signs of overvaluation had circulated among more cautious economists for months, largely unheeded. The market's decline had actually begun days earlier, but October 29, 1929, remembered ever since as Black Tuesday, brought the most severe single-day collapse of the crisis, with the New York Stock Exchange losing roughly 12% of its total value in a matter of hours, as panic selling overwhelmed any attempt to stabilize prices. Investors who had bought on margin found themselves owing far more than their shares were now worth, wiping out savings that in many cases had taken a decade of careful accumulation to build. The broader economic depression that followed would stretch across the next 10 years. The tide had looked endless right up until the single day it finally went out. For years, one respected figure on Wall Street offered his clients something almost nobody else could reliably deliver: steady, unremarkable returns that never seemed to falter, in good markets or bad. It took a single evening's confession to his own sons to reveal there had never been any returns at all. Bernard Madoff had run a legitimate market-making business for decades, a reputation that lent enormous credibility to the separate investment advisory arm of his firm, which quietly took in billions of dollars from individuals, charities, and institutional investors over the years. Rather than actually investing the money as claimed, Madoff simply used incoming funds from new investors to pay the promised returns to earlier ones, the same basic structure Charles Ponzi had used decades earlier, only sustained on a far larger scale and for a far longer period. The scheme finally became unsustainable in 2008, as the broader financial crisis prompted a wave of investors to request withdrawals faster than new money was arriving to cover them. In December of that year, Madoff reportedly told his sons that his business was, in his own words, one big lie, and they alerted authorities the following day. Investigators estimated the fraud's paper losses at around $65 billion, one of the largest financial frauds ever uncovered, and Madoff was sentenced to 150 years in prison, where he died in 2021. The returns had always been steady, because they had never actually depended on any market at all. A bank that had survived Napoleon's wars, 2 world wars, and roughly 230 years of European upheaval, was undone within weeks by one trader working out of an office in Singapore. Nike Lee Sun worked as a derivatives trader for Barings Bank, and beginning in the early 1990s, he began accumulating unauthorized trading positions that he hid from his superiors using a secret internal account. Rather than reporting early losses and accepting the consequences, Leeson increased his bets in an attempt to trade his way back to even, a pattern that only compounded the losses as markets continued moving against him through late 1994 and into early 1995, particularly following an earthquake in Kobe, Japan that shook the markets he was heavily exposed to. By the time Barings management discovered the scale of Leeson's concealed positions in February 1995, the losses had reached an estimated £827 million, a sum that exceeded the bank's entire available capital. Barings, unable to absorb a loss of that size, collapsed within days and was eventually sold to a Dutch bank for a nominal sum. Leeson fled but was eventually arrested, extradited, and served several years in prison in Singapore. One trader's hidden account had, in a matter of months, undone what 2 centuries of careful banking had built. A firm old enough to have survived the Great Depression, 2 world wars, and more than a century of financial crises ran out of options over the course of a single weekend in September 2008. Lehman Brothers had, like many Wall Street firms in the mid-2000s, expanded heavily into mortgage-backed securities, packaging home loans into investments that were sold to investors around the world. When housing prices began falling and mortgage defaults rose sharply through 2007 and 2008, the value of those securities collapsed, leaving Lehman holding assets worth far less than the debt it had used to acquire them. As rumours of the firm's weakened position spread through the market, its stock price fell sharply, and its ability to borrow the short-term funding investment banks depend on to operate day-to-day evaporated. Over the weekend of September 13 and 14, 2008, federal officials and rival bank executives met in emergency sessions attempting to arrange either a buyer or a government-backed rescue for Lehman, the way earlier troubled firms that year had been handled. No deal materialized, and unlike those earlier cases, the government declined to intervene directly. On the morning of September 15, Lehman Brothers filed for bankruptcy, the largest such filing in American history, an event widely regarded as the moment the financial crisis moved from serious to historic. 158 years of survival ended not in a single bad trade, but in one weekend nobody could find a way through. A handful of state legislators sold off an almost unimaginable expanse of public land, much of it to companies they secretly owned themselves. A newly elected legislature undid the entire sale and burned the evidence in public to make certain everyone understood it was undone. In 1795, the Georgia state legislature approved the sale of some 35 million acres of western land, territory that today makes up most of Alabama and Mississippi, to 4 land companies for a total price that worked out to a fraction of a cent per acre. Investigation soon revealed that most of the legislators who had voted for the sale held secret financial interests in the very companies buying the land, a conflict so blatant that public outrage led to a wholesale replacement of the legislature in the next election. The new legislature moved decisively, passing a rescinding act in 1796 that declared the original sale void and, in a piece of political theatre meant to leave no doubt about the finding, publicly burned the original legislative act using a magnifying glass to focus sunlight onto the paper rather than touching it with what was called unhallowed fire. The land companies and speculators, who had purchased shares, expecting enormous profit from reselling the territory, were left holding certificates for land they no longer legally owned, and the dispute over compensation dragged through courts and Congress for years afterward. The fire that burned the fraudulent act was, by design, no ordinary flame. The fortune it destroyed was ordinary enough. A failed attempt to corner a single copper company's stock spread within days into a crisis threatening the stability of New York's entire banking system. The Knickerbocker Trust Company, one of New York's largest trust companies, had ties to a group of speculators who attempted in October 1907 to corner the market in shares of the United Copper Company. The scheme failed almost immediately, and word that Knickerbocker's president had been involved in the failed venture triggered a wave of withdrawals as depositors, worried about the trust company's own soundness, rushed to pull their money before others could get there first. The Knickerbocker Trust was forced to suspend operations, and the panic it sparked spread rapidly to other trust companies and banks across the city, each new failure feeding fear about the next. With no central bank yet in existence in the United States to coordinate an official response, financier J.P. Morgan personally assembled a group of leading bankers in his own library, pressuring and cajoling them through a series of late-night meetings into pledging enough combined capital to stop the panic before it spread further. The crisis subsided within weeks, though the episode's dependence on one private individual's intervention became a central argument for creating what eventually became the Federal Reserve System in 1913. A copper scheme had nearly brought down a city's finances. One banker's library, for a few tense nights, held the whole system together instead. A former president of the United States trusted his family's entire savings to a firm run by his own son and his son's business partner. The partners' fabrications cost the family everything within a single collapsed morning. After leaving the presidency, Ulysses S. Grant invested heavily in Grant & Ward, a banking and brokerage firm his son Ulysses Jr. had formed with a younger financier named Ferdinand Ward, a man whose confident manner and apparent success had earned him considerable trust, despite a career built largely on fabricated claims of lucrative government contracts and insider deals that did not actually exist. Grant, trusting his son's judgment and Ward's evident success, invested essentially his entire personal fortune in the firm, and even took out additional loans to invest further when Ward requested more capital. Ward had, in reality, been running the firm's finances on borrowed money and the classic structure of paying earlier obligations with money raised from newer sources, a scheme that inevitably could not sustain itself indefinitely. In May 1884, the firm collapsed when Ward's fabricated deals finally failed to produce the funds needed to cover the firm's actual debts, leaving Grant not only destitute but personally liable for loans he had guaranteed. Grant spent his final year, while dying of cancer, writing his memoirs specifically to provide his family with income after his death, a project completed just before he died in 1885. The presidency had made him a national hero. One firm's fraud left him writing for his family's survival at the very end of his life. A bank counted among the largest in the entire United States discovered, within the space of a few days, that being large did not make it safe, only more dangerous to let fail. Continental Illinois National Bank had grown aggressively through the late 1970s and early 1980s by extending large loans into the booming energy sector, a strategy that performed well while oil prices stayed high but left the bank badly exposed. Once prices began falling, and a wave of loans it had purchased from a smaller troubled Oklahoma bank turned out to be far riskier than represented. As losses mounted through 1982 and 1983, rumors about the bank's soundness began to circulate among the large institutional depositors and foreign banks that made up a significant share of its funding. Unlike a traditional bank run involving lines of ordinary depositors, Continental Illinois' crisis in 1984 unfolded largely among sophisticated institutional lenders who withdrew billions of dollars within days once confidence cracked, a modern version of a bank run executed by wire transfer rather than by standing in line. Regulators concerned that the bank's failure could destabilize the broader financial system given its size and connections, arranged an unprecedented federal rescue, effectively nationalizing the bank temporarily and coining the phrase "too big to fail" in the process. Its size had been meant to signal strength. Instead, it meant regulators could not risk finding out what its failure would actually cost everyone else. A single embezzlement at the New York branch of an Ohio insurance company set off a financial panic that spread across the entire United States within weeks, revealing just how tightly the era's finances had become wired together across distant states. The Ohio Life Insurance and Trust Company had, alongside its insurance business, operated a New York branch heavily engaged in lending to railroads and other speculative ventures. In August 1857, it emerged that the branch's manager had embezzled a substantial sum of the company's funds, and the resulting insolvency forced the company to suspend payments entirely, a failure that on its own might have remained a regional story. Instead, the collapse triggered a broader loss of confidence at a moment when American railroad expansion had already left banks and investors carrying more speculative debt than the actual economy could easily support. Additional pressures, including a decline in European demand for American grain and a general tightening of credit following years of expansion, compounded the shock. Banks across the country faced runs from depositors, and a wave of business failures and unemployment followed through the remainder of the year, a downturn that, while shorter than some later panics, was severe enough that it fed directly into the political and economic tensions of the years leading up to the Civil War. One branch office's embezzlement had within a season become a national reckoning. A mountain of silver ore in the Nevada desert had for a decade and a half made a small number of men extraordinarily wealthy, and turned a remote mining camp into one of the richest cities per capita in the world. The ore simply ran out faster than anyone had planned for. The Comstock lode, discovered in 1859, produced silver and gold in quantities that transformed Virginia City, Nevada from a rough camp into a genuine boomtown, complete with opera houses, ornate mansions, and a stock exchange dedicated entirely to trading shares in the mines themselves. Figures like William Sharon and the group of investors popularly known as the Bonanza Kings amassed fortunes large enough to fund banks, railroads, and political careers across California and Nevada, and speculative trading in mining shares became almost as lucrative, for a time, as the mining itself. By the late 1870s, the richest and most accessible ore bodies had been substantially exhausted, and the deeper deposits that remained proved far costlier to extract than the easy silver of the boom's early years. Mining shares that had once traded at extraordinary prices collapsed as production declined, and Virginia City's population and fortunes shrank steadily through the following decades. Some of the wealthiest men of the Comstock era retained fortunes built during the peak years, but the mines themselves and the speculative frenzy surrounding their shares never returned to anything resembling their earlier heights. The mountain had given up its silver freely for a while. It gave up nothing at all once the richest veins were gone. A respected engineer, who had once served as Thomas Edison's personal secretary, built one of the largest corporate structures in American history, a pyramid of holding companies controlling electricity across much of the country. The structure needed constant new investment simply to remain standing, and when that investment stopped, it stopped almost overnight. Samuel Insull had risen from Edison's assistant to become one of the most influential figures in the American electric utility industry, consolidating dozens of local power companies into vast interlocking holding companies based in Chicago. The structure allowed Insull to control an enormous base of underlying utility assets while owning only a comparatively small direct stake, financed through layers of debt and stock, issued by companies that in some cases existed mainly to hold shares of other companies further down the chain. That structure depended entirely on continued investor confidence and access to fresh capital to service its substantial debts. When the stock market crashed in 1929 and credit tightened dramatically in the Depression years that followed, Insull's empire, unable to refinance its obligations or raise new capital, collapsed within days in 1932, wiping out the savings of hundreds of thousands of small investors who had bought shares believing utilities to be among the safest investments available. Insull fled the country to avoid prosecution, was eventually extradited, and though acquitted of the most serious fraud charges, died in relative poverty in 1938. A structure built layer upon layer of paper proved, in the end, only as strong as the willingness of strangers to keep buying more of it. A Paris bank encouraged thousands of ordinary French investors to buy its own shares on borrowed money, driving the price to levels the underlying business had no realistic chance of justifying. The price fell just as fast as it had risen within a matter of days. The Union Générale Bank, founded with the backing of prominent Catholic interests in France, grew rapidly during the late 1870s, partly through legitimate banking and industrial investment, and partly through a speculative promotion of its own stock, encouraging small investors, including many with modest savings, to buy shares on margin in the expectation of continued gains. The bank's share price climbed dramatically through 1881 as buying momentum fed on itself, drawing in ever more investors convinced the rise would continue indefinitely. The bubble began to deflate in late 1881 amid broader concerns about speculative excess across the Paris Stock Exchange, and when rival financial interests, some accounts suggest deliberately, began selling Union Générale shares heavily, the price collapsed within days in January 1882, triggering the bank's outright failure. Thousands of small shareholders, many of whom had borrowed to buy in, lost the bulk of their savings, and the collapse contributed to a broader crisis on the Paris exchange that took years to fully recover from. The shares had climbed on confidence, borrowed as heavily as the money that bought them. Both ran out at the same moment. A London banker made an enormous bet that a company's stock would fall. The stock rose instead, and his failure to cover the losses froze credit across an empire within weeks. Alexander Fordyce, a partner in a London banking house, had built a considerable personal fortune through banking and speculation before attempting, in 1772, a large short sale against East India Company stock, wagering that the company's shares, then trading at historically high levels, would soon decline. The stock instead continued climbing for a period, and as Fordyce's losses mounted beyond what he could cover, he fled to France in June 1772 to escape his creditors, leaving his bank unable to meet its obligations. The failure of Fordyce's bank triggered an immediate credit crisis across London, as other banks and merchants who had extended credit based on assumptions of continued stability suddenly found themselves exposed to a chain of defaults spreading outward from his collapse. The panic reached beyond Britain itself, contributing to financial strain in the American colonies at a moment already thick with political tension, and some historians have argued the resulting credit contraction indirectly worsened conditions that contributed to unrest in the years leading up to the American Revolution. A single failed short sale had, within weeks, tightened credit across an ocean. A regional Scottish bank had lent generously through years of good business, confident the good years would continue. When a London banker's failure sent shockwaves through British credit, the Ayr Bank discovered how much its partners personally owed. The Ayr Bank, formerly known as Douglas, Heron and Company, had been founded in Scotland in 1769 with ambitious plans to expand credit throughout the region, extending loans more freely than its more established rivals in Edinburgh considered prudent. For a few years the strategy appeared successful, fueling local business expansion and building the bank's reputation as a generous and accommodating lender to farmers, merchants and landowners across southwestern Scotland. When Alexander Fordyce's London bank failure in June 1772 triggered a broader British credit crisis, the resulting scramble for liquidity exposed just how overextended the Ayr Bank's own lending had become. Unable to call in loans quickly enough, or secure fresh credit from increasingly wary counterparts, the bank suspended payments within months and was formally wound down over the following years. Because Scottish banking partnerships at the time carried unlimited personal liability, the bank's partners, many of them prominent landowners, were left personally responsible for debts that in some cases cost them estates that had belonged to their families for generations. Generosity, in good years, had built the bank's reputation. Personal liability in one bad year dismantled the fortunes of the men who ran it. Cheap credit after a war can feel, for a while, like a country handing out free money. The Panic of 1819 arrived to remind American land speculators that the money had always belonged to someone else. Following the War of 1812, the Second Bank of the United States and a proliferation of state-chartered banks extended credit freely to settlers and speculators eager to buy Western land, much of it purchased with only a small down payment and the rest financed on generous terms that assumed rising land prices would make repayment easy. Land offices sold enormous tracts on credit throughout the late 1810s, and speculation drove prices in many frontier areas well beyond what agricultural income from the land could realistically support. Concerned about its own reserves and rising defaults, the Second Bank tightened lending sharply beginning in 1818, calling in loans and refusing to extend the easy credit that had fueled the boom. The resulting contraction spread rapidly. As banks failed, land values collapsed, and speculators who had bought on credit found themselves owing far more than their land was now worth. The downturn that followed, remembered as the Panic of 1819, was widely regarded as the young republic's first major peacetime financial crisis, and it fed public anger toward banking institutions that lingered in American politics for decades afterward. The land itself had not changed, only the willingness of banks to pretend its price could keep climbing forever. A property boom financed heavily by British investors convinced Australian colonial banks that land prices in Melbourne and Sydney could climb indefinitely. A single season in 1893 proved otherwise, and it proved it to more than a dozen banks at once. Through the 1880s, substantial British capital flowed into Australia's colonies, financing rapid urban and rural land development on the confident assumption that continued population growth and rising prices would justify the investment. Colonial banks extended credit generously to fund the boom, often accepting land itself as collateral, valued at prices that had already climbed well beyond what rental income or agricultural returns could support. When British investors, growing cautious after a series of warning signs including the earlier BAR-ing crisis scare in Argentina, began withdrawing capital from Australia in the early 1890s, the resulting credit contraction exposed how overextended the colonial banking system had become. A wave of bank suspensions swept through the colonies in 1893, with more than a dozen banks closing their doors within a matter of months as depositors, alarmed by each new failure, rushed to withdraw funds from institutions still standing. The resulting depression set back the Australian economy for years and reshaped colonial banking regulation for a generation afterward. British money had built the boom from a distance. It left just as easily and just as fast once distance stopped feeling safe. The wealthiest corporation the world had ever seen did not end in a dramatic crash or a single terrible morning. It ended quietly, on paper, when a government simply declined to renew a charter that had already stopped meaning very much. The Dutch East India Company, founded in 1602, had once paid its shareholders extraordinarily generous dividends year after year, built on a trading monopoly across Asia that gave it something close to sovereign power over vast territories and populations. For much of the 17th century it stood as the wealthiest and most powerful commercial enterprise on earth, with its own army, navy and authority to negotiate treaties on the Dutch government's behalf. By the 18th century, corruption within the company's ranks, mounting debts from costly wars to defend its territories, and increasing competition from British and other rival trading interests had eroded the company's profitability steadily for decades. Its finances deteriorated to the point that the Dutch government itself effectively took over its debts in the 1790s, and when the company's charter came up for renewal in 1799, amid the broader upheaval of the Napoleonic era sweeping across the Netherlands, it was simply allowed to lapse rather than renewed. A company that had once ruled trade across an ocean ended not with a headline but with a government form left unsigned. A wave of newly founded companies flooded Vienna's stock exchange with shares of wildly uneven quality, encouraged by a speculative mood that had gripped the Austro-Hungarian Empire for several years. On a single afternoon in May 1873, the confidence behind all of it broke at once. Following a period of rapid economic growth and easy credit across the empire, hundreds of new joint stock companies were founded in the early 1870s, many with only the flimsiest underlying business behind their public offerings, a promotional frenzy that historians of the period sometimes call the Founders' Era. Speculation in the shares of these newly formed companies drove Vienna's stock exchange to levels that bore little relationship to the actual value of the businesses being traded. On May 9, 1873, a collapse in confidence, triggered in part by rising interest rates and growing skepticism about the flimsier new companies, set off a rapid selling wave that crashed the exchange within a single trading session, a crash remembered in German as the Gründe Krach. The panic spread quickly through Central Europe's interconnected banking system, contributing to bank failures and business closures across Austria, Germany, and beyond, and marking the beginning of a broader economic downturn that lasted through much of the decade. The companies had been founded quickly and priced eagerly. The exchange unwound both in a single afternoon. A respected Italian bank's chairman had spent years building a network of offshore holding companies that concealed enormous unsecured loans, some tied to accounts linked to the Vatican itself. Days after his bank collapsed owing well over $1 billion, he was found dead beneath a London bridge. Roberto Calvi led Bancombroziano, one of Italy's most prominent private banks, and cultivated relationships that reached into the Vatican's own financial administration, arrangements that for years lent his bank an air of unusual credibility and protection from ordinary scrutiny. Behind that credibility, Calvi had constructed a web of offshore subsidiaries, particularly in Latin America, used to extend loans that were never properly secured or repaid, loans that ultimately amounted to well over $1 billion in losses once the true state of the bank's finances came to light. Italian authorities began investigating Bianco Ambrosiano's finances in 1982, and as the scale of the shortfall became apparent, the bank forced into liquidation that summer. Calvi fled Italy under a false passport, and on June 18, 1982, he was found hanging from scaffolding beneath Blackfriars Bridge in London, his pockets weighted with bricks and cash, a death initially ruled a suicide but later reclassified as a probable murder following a subsequent Italian trial, though the case remains formally unresolved to this day. The bank's losses were eventually accounted for in courtrooms. The man who built them was never fully accounted for at all. When a scheme built on political favours and inflated promises finally collapses, someone eventually has to answer for it. In the case of the South Sea bubble, that someone turned out to be the company's own directors, and Parliament's answer was to take back what they had already spent. The South Sea Company had secured its original monopoly, and its later debt conversion scheme partly through bribes, distributed to members of Parliament and other officials, ensuring political cover for a venture whose actual trading prospects had always been far thinner than its stock price suggested. When the bubble collapsed in the autumn of 1720, ruining thousands of investors across British society, public fury demanded not merely an inquiry but genuine accountability from the men who had profited most while the crowd lost everything. A parliamentary investigation in 1721 uncovered extensive evidence of bribery and insider dealing among the company's directors and several government officials, and rather than relying solely on ordinary criminal prosecution, Parliament passed a specific act permitting the seizure of the directors' personal estates to help compensate the investors they had misled. Several prominent directors, along with at least one government minister, saw significant portions of their private wealth confiscated under the Act, an unusually direct form of financial restitution for the era. The bubble had made its promoters rich on promises. Parliament's Act made a point of taking most of that richness back. Somewhere right now, a ledger is closing on a balance that will not survive the week, and the person keeping it has no idea yet. That has been true in every century this list has passed through, from a Lydian treasury to a Singapore trading desk, and there is no particular reason to think it stops being true now. What is strange, looking back across 50 of these mornings, is how rarely the fortunes fell to anything exotic. Most of them fell to the same handful of very human habits. A confident man who believed his own paperwork, a crowd that mistook a rising price for a rising truth, a lender who kept extending credit because the alternative felt ruder than the risk. The tools changed. Coin gave way to paper, paper gave way to wire transfers, and the wire transfers now move faster than any single mind can track. The habits underneath them changed very little at all. None of this is a warning, exactly, and it is certainly not a set of instructions. It is simply an old, well-documented pattern, told the way it actually happened, in rooms full of real people who believed, right up until the morning they did not, that what they had built would hold. The ledgers keep closing, some balance and some never do again,